everybody. About to be show time. Come on in. Come on in. Come on in. Righty who? Right. How are we all doing? Welcome to Tuesday. Good to see you, Esther. Good to see you, Gerard. Everyone, just let me know that you can hear me loud and clear. You know the drill. It's been a day and 3 halves for me. Good to see you, Priscilla. If you're in the comment section, good to see you, Gerard. If you're in the comment section, just let me know, especially if you're a registered student, let me know who is here. As usual, we will do our best to tailor the session to who is actually in it. Everybody else can catch up on it in their own time. But we want to take the time to make sure that those who are actually in the session get the most out of it. Good to see you, Reggie. Right, so I've got some liquid here with me that I'm going to need to keep my eyes open. So if you hear me slurping, have mercy. It's been that kind of day, but we'll get through this together. So today we're going to be going through the week so far in our pairs, the pairs that are on our watch list. And so if you don't know, for us this week, that is the euro dollar, EU, the pound dollar, GU, and the Swissy, UCHF. So we did a pre-week analysis on Sunday night. We did a Monday evening look. And things are playing out quite nicely. I wish I had my charts to show you before and afters, but I don't think I took screenshots on Monday and Sunday. But for those of you who were there, you will remember. Right, so cool. 1 second. Let me just check real quick. Something real quick. All right, cool. Excellent. So as always, we're going to start from the dollar index. What has the dollar index done? 1 second. When the week started, let me get rid of this Fibonacci. When the week started, this was our preference. If you remember, starting with the D1 chart, the daily chart, we draw out this order block here and then a smaller one here. So let me just show you where this is coming from. This is actually a smaller order block inside the bigger order block. We draw that line of support, that candle here, that low. And we said we thought it was very likely. One quick second. Okay. So we thought it was very likely for price to take out that low, dip into this lower order block here. It hasn't done that. That's fine. And then rally. So that was one of our start of week scenarios. Of course, we also pointed out the fact that this low here that formed on the 10th of June at the moment has not been attacked. So that low there is holding firm in the dollar index. And then we usually start from EU. We went through the different pairs. So in EU, 1 second, I think, yeah, this is it here. that's the commensurate high. Of course, the Euro EU is inversely correlated to the dollar index. If the dollar goes down, you would expect EU to go up, and vice versa. That's the high there, the 10th of June. Or I think it could have been the 9th of June in EU. Yeah, it is the 10th of June. This is the high. You know what? Let me layer these charts one on top of the other so you can see what I'm talking about. So if we have that there, let's get the dollar index daily. That would be there. Okay. All right. So if you see them layer that high there, put this there. Actually, so that high there lines up with this one here. That intermediate high there lines up with this one here. This order block, this would be the full order block. But then if we refined it like we taught today in the afternoon, how you can refine an order block on a lower level. If you refined it, that would be the refined level there. Because if you drop down to a 4-hour chart, you would see it. That's the level. That's a rejection order block. We're going to look at that next week. So, right, let's bring this further down. So we see that as price dipped below this level there, it touched that there. That was last week. And then today it cleared there into that zone. That's the commensurate. It says telling me that we're live. You're about 10 minutes late, 15 minutes late. So that's this here. So we can see that EU is lining up perfectly with the dollar index. So this week, we know we can trust EU when we see a signal in the dollar index. We can trust the euro dollar to give the same signal. And if we see a signal in the euro dollar that lines up perfectly with the dollar index, we can take it with confidence. Now, I am waiting. Like I said, if I'm going now, today would have been a great opportunity to go long. I'm going to show you that in a second. But I'm waiting for a short, and I'm ready to wait. I don't like to take too many trades in a week. I want one, maybe maximum 2 trades a pair per week. And so I'm waiting for what I think is going to be a nice short at some point this week. I wanted to take the long today, but then I decided against it. It's set up at a time where I wasn't prepared for it. So I'm just going to wait for the short if it presents itself. And I'll show you what I've already showed you what to wait for, and it's lining up perfectly. And you see, this is what we drew out in the Swissy. Let me see if I can find the chart where we drew it out in the euro dollar in advance. Anyway, that's fine. So that's it there. Now let's look at the Swissy. I'm going to line it up with the dollar index so we can see. The Swissy has done pretty much exactly what we knew / thought it was going to do. However, with the Swissy, we saw a divergence. Now, this is the kind of divergence that market makers use or cause, not your stochastics, not your RSI. Look, this low here lines up with this one here, right? In the Swissy, it was taken out last week, but it wasn't taken out in the dollar. In essence, somebody pulled the Swissy down without pulling the dollar down. That tells us two things. One, this manipulate, because this, I'm of the opinion this is a manipulation. I'm of the opinion this was a stop rate manipulation, and we are likely to either maybe it drops down again or just go straight up from there. But if the dollar turns out to be bullish, then we would expect the Swissy to also be bullish, in which case this would have been a stop hunt raid. But the fact that this happened and we did not see the dollar take out that low there tells me that there is probably some strength in the dollar. That gives me even more of a belief that it could be in that zone there, or like we drew this on Sunday, we could see it happen here. We could see it happen here, in which case this candle could come all the way, or this arrow could come all the way down there and then up there. But I do expect over the next week or so, I do expect this level to be taken out in the dollar. It's double highs here on the daily chart. I bet you my last pair of trousers, we're going to see this happen at some point. Whether it's this week or next week or even the week after, we don't know. But at some point over the next month, I'm willing to bet you a pretty penny that this will happen. Why? Because that's how market makers think. There is likely going to be a liquidity pool, P-O-O-L, here, in this region here. And wherever there is a liquidity pool, P-O-O-L, we are likely to see a liquidity pool, P-U-L-L. And this could just carry on all the way up here, but that's my call over this next week or so. If that's the case, then we should see the Swissy. We should see the Swissy rise as well. So we looked at Swissy, looked at EU. Let's look at GU now. GU is the outlier. 1 second. Let's find the chart that we've already. There we go. Now remember, we drew these out. We drew part of it out last night and the other part this afternoon. Let me show you this first of all in full. Now, on a daily chart, GU wasn't hanging around. Yesterday was an engulfing off that daily level there. Now, it is the only one that engulfed yesterday. But I told you that I didn't necessarily trust it. Remember I said so? Because it was out of sync with the dollar. Let's find that. So that's the Swissy, that's the dollar index there. You can see here, that high corresponds to that low. This high here corresponds to this low here. Like the dollar, it did take out that high last week. So we did see that happen. We did see that happen. Let me get rid of that. However, it dipped back into its order block quickly and formed a reversal pattern. But that was not driven by here. We didn't see the same reaction here. We didn't see an engulfing there. And so when we dived into it on a lower time frame, okay, I'll leave that for a second. On the 4 hour, this is what happened to start the week. There was a stop hunt there. And then price broke market structure here. as it broke market structure there, if you drop down to 1 hour chart, which this is here, so that's the stop point. You can see it nicked it literally by, I don't know, let me see, how many pips is that? It literally only needs to cross it by 1 pip that factors in the spread, and that's it. So that's three pips. That's fine. That's a valid market structure. That's a valid stop on. And it came down, formed this manipulation candle here. That's what this white line is. It's a manipulation candle there. This candle here to start the week. Came all the way down, and then price pushed back up above it. That becomes a manipulation block there. Also, this blue line here is a fair value gap. You can see price pushed below that level there, came back up into it, and then ran. And then it takes out Friday's low here yesterday, and then today it took out Wednesday's low. So this to me has shown an intention. Something in the pound is pulling this down, even though the dollar is not ready to go. Now, I want you to think of it from this perspective. When the dollar starts to go up, the pound is really going to fall, right? It's a fraction, the GBP over the USD. If the bottom half of the fraction increases, then the overall fraction's value reduces. The dollar hasn't begun to run up yet, and the pound was already falling on a daily chart. It had already started its descent. When this really begins to rip upwards, that's going to come down like a freight train. However, it's left us clues. Just the same way it did this up here. Manipulation block, market structure break and return to it, and failed in the fair value gap. So I'm going to delete that now that you've seen that. For the sake of space, it's formed another fair value gap here. It's ripped through that level and run away without touching it. And there is a manipulation block here as well. And so if the dollar gives a bullish signal tomorrow, sorry, just slurping on my liquids. If the dollar gives a bullish signal tomorrow, this is an area in which we could see a reversal in the pound dollar. Emphasis on could. It could very well come all the way back to this level for a second touch. That should be purple, and that should be blue because this is a 1 hour chart. For those, if anybody here is new, I know I have at least one new student in the chat today. I operate a very interesting color code scheme. When I draw lines on my chart, I put them in different colors based on what time frame I drew the line from. So when I see that line on a lower time frame, I know to respect it because it came from this particular higher time frame or the other. So we could potentially see it come all the way back here. Some of you asking the question, so how will we know? Well, we will wait for confirmation. Remember, the elephant cannot run through our garden without leaving footprints. We don't try to guess when the elephant is coming. We just anticipate it will come, and then we wait for it to come. It cannot hide its tracks. These guys are trading too big in terms of their order sizes. They will leave clues, and because they are trading so large order sizes, they will not get all their orders filled half the time. In essence, they will need to revisit the level to pick up the orders that were not filled the first time. If that came there, that would be here. That would be there. So this could be Wednesday, this could be Thursday. That's what I'm expecting. That's taking out 2 days running. Now, I almost took this trade today. Let me show you this one here. Because if you remember, we drew out this level already in the morning at 11. We drew this level out at 11 in the morning. When this came here and gave this reaction, I was very tempted to take that trade just to get something in the bank for the week. That would have been 20 pips. That would have been a healthy 3-1. But I decided to wait. I decided to be patient and wait. Right. So that's the pound. Now, also in the EU, let's go back to the EU now, the euro dollar. I was in two minds. Again, I almost took a long on this today, and that would have been the right thing to do. But between preparing for our class and a couple of other things, I've been up since 6 a.m. in the morning. I had a prayer meeting, my church at 7 in the morning. So I decided to leave it and wait for the short. But look at this. This is perfect price action. Why? Let's look at this real quick. Now, unlike the pound, we did not see an engulfing yesterday. And so the last engulfing on the euro dollar is bullish. Oh, I've drawn it out already. That's this one here. The last engulf, no, I haven't drawn it actually. That's this one here. This candle there. When yesterday's candle closed higher than Friday's candle. So this is Tuesday. This one's Tuesday. This one's Monday. This is Friday. Tuesday or Monday closed higher than Friday. It also made a higher high than Thursday's high, but it came back and closed above there. How often do we see this happen again and again and again? Just get rid of that one there so you can see it. See that there? This happens all the time. Sometimes it just nicks beneath it. Get rid of that. That level there is a perfect support for the next day. And we understand how price works. On an up day, it will open up, go the other way, find support, and then rally. On a down day, 1 second, guys, please. Give me a quick second. Sorry, guys. On a down day, it'll do the opposite. It will open up. Let's look at a down day here. This is a down day. Price opens up. It goes the other way, finds resistance somewhere, and then passes down. On an up day, it's the exact opposite. It opens up. See that there? It comes down, finds support, and then rallies. The question is, where is it going to find support? And where is it going to find resistance? Well, this is the answer here. This is the answer right here. Historical price levels. And one of the historical price levels, remember we taught this, that you're on a weekly chart and a daily chart, specifically on a weekly chart, if your reference time frame is a 4-hour chart, that you should do open, high, low, close on the weekly, right? Because one weekly candle is a 4-hour divider. Well, on this particular trade, my reference time frame is the hour chart or the 15-minute chart, in which case I need to know what my open, high, lows, and closes are of the daily chart. Open, high, low, close. Same for here. Now, let me look at this. Look at this in more detail here. I'm just going, so price was here today, right? In which case we want the open, high, low, and close for every candle, right, in the last 20 days. Remember we said that? That could affect that price. So I'm just going to, let me take this off real quick and show you how this magic happens. So as of this morning, price was there. It was there. This is the last thing we saw, right? So the close of this candle, in essence, as of this morning, this was where price was. When we woke up this morning, or when yesterday ended, price was at that level there. This level here, right? So ask yourself, count back 20 candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So that would be up to here. However, that there is exactly where price was. So today's going to go up or down, right? If it goes down, the average daily range is for the euro dollar is roughly about anywhere between 60 to 150 pips. 150 pips low from there. That's the lowest candle it could potentially get to in one day. 150 pips up from here definitely takes it through this candle. So it is not unheard of for price to do 82 pips in one day, in which case we need to take this high into consideration. So I'm going to show you open, high, low, and close of every single candle that could have affected today's price. Let's get rid of that. That candle's high, that candle's high there. I'm going to put them in green because green is my daily time frame color. And where the same level is shared by multiple candles, I'm not going to draw multiple lines so it doesn't become too cluttered. Bear in mind, we don't have this candle to work with today as at last night. Today's candle didn't form when we should have been doing open, high, low, and close. So this one's open and this one's close are pretty much the same. So I'm going to leave that line to account for both of them there. And you just work your way down from the highest candle to the lowest candle. That's the open on that one. So that's the open. Sorry, that's the open. That's the high. This is the close. It's going to get rid of that. And this is the low. Right? And then we come to the next candle. Well, the high is already there. This already takes into account the open. That's the low there. That's the open, sorry, there. And I'm not going to bother. Actually, I will draw it. You know, I'm not going to bother drawing the close or the low, sorry, because we know that it doesn't affect there. But actually, let me just draw it for the sake of completeness. If we draw that low, so that's what it will look like, right? And then you do the same for every single candle from this one all the way back to this one. But you will notice that many of them will already respect. So this candle, they respected that one. So I'm not going to bother drawing this and that. Well, I could draw this one here, but I'm not going to draw that because that's too close to it. And so you just use your insight to imagine this line drawn on every single high, open, low, and close that does not line up with each other. If two are 1 or 2 pips apart, just leave one line there. But look at how we predicted today's candle and yesterday's candle with amazing efficiency. First of all, let me draw one more here. This candle's open here, even though there was a gap the next day. That candle's open there. So it closed there, sorry, from the low there. So you can see how with amazing efficiency, we predicted the last 2 days of price action just from doing historical levels. If you drop down, like we taught, you drop the liquidity profiles, you drop them down to smaller time frames or lower time frames. There you have it. You see that there? And if you took it one step further down to a daily time, to an hourly time frame, this is where it really starts to look like magic. Now, bear in mind, every single green line on that chart could have been drawn from 2 days ago. I want you to bear that in mind. Every single green line on this chart came from at least 2 days ago. Reggie, does the 20-day count apply to all current pairs? Yes. I'll just write that down in your notes for now. We will explain that in the Market Breakers course, where we get 20 from. There's a reason for where we get 20 from. The short answer is there are 20 trading days in every month. If you take out the Fridays and the Saturdays and the Sundays, so take out the Saturdays and the Sundays, there are 20 trading days every month. And so we're literally going back 1 month of trading days. That's it. Now, it's not as simple as that. I just gave you 20 to use today for the sake of time. But there's actually a slightly more refined way to do it. It's usually 20 plus something. The something you learn in the Market Breakers course in your advanced or intermediate section. So these lines here are from over the last 20 days. And all of them, except for this one here, are from these two candles. Bear that in mind. These two candles that are more than 20 days ago, 20 trading days ago, so about a month ago, have supplied every single green line on this chart except for this one here. That's the only one they've not supplied. And that one comes from the close of 2 days ago. The close of the candle that was engulfed. That's where it comes from. Everything else comes from 20 days ago. When you drop down to a 1 hour chart, price opened there. So that was the opening. Well, this here was the opening price, which was also yesterday's closing price there. It drops down to where? To a liquidity profile here. This here is an order block from the previous day. The other option was this one here. These were the two options of where price was most likely going to find support. There or here. Now, why have I drawn that halfway through the block as opposed to taking the entire block? Some of you are wondering. This would have been the full way to draw it, right? Why have I drawn it there? Well, I refined it. If you drop down to a 15-minute time frame, I refined it using this here. You see that? So that's the refined. Leah Levi, hello. Okay. Leah, I'm not sure what that question is. The live video, well, if you listen to it, you'll figure out what it's about. So that's why it looks smaller, because I dropped down to a 15-minute time frame to refine it. And actually, to be on the safe side, I'd probably take this one here. That's the bigger one. So you don't miss the trade trying to be too cute. So there. That's the safe way to do it. We go back to 1 hour chart. So it comes in there and you get a reaction. If you were trading this purely off the 1 hour chart, you would have been entering at the 1 hour engulfing there. So the moment price passes that candle, it engulfs it. You don't need to wait for the candle to close. The moment it shoots past it, you would have been in that trade. Your stop loss. So now you're assuming that's the low of the day, right? So you're making the assumption that that's the low of the day. If the low of the day formed in that order block, you put your stop loss at the bottom of the order block. That would have been 20 pips. And it would have given you a nice 3-to-1. However, if you refined it further using a fifth, so this is how you would have refined it. Rather than take the 1 hour engulfing, you would have waited for a 15-minute market structure break there. So this is when it broke market. 1 second. This is when it broke market structure on a 15-minute chart. Now, this entry was, guess what? So this is 10:30 server time. That's 8:30 in the morning. When do we say we stalk entries? 6 to 10 a.m. London time, 12 to 3 p.m. New York time. So that would have been the time to get that one. If you miss that one, well, you come back at 12 noon in the afternoon and start stalking again. Well, 12 noon in the afternoon would have been 2 p.m. server time. So in essence, we would have been stalking the trade from here. From this point onwards, well, did it give you an entry? Yes, it did. So if you waited for this to clarify as a market structure break, in essence, you don't take that trade during London. You wait for an expansion and a retracement in New York. That's the expansion leg. From there, so that's the market structure break. It forms a low. This could have formed in here. That wouldn't have made any difference. But it's formed a higher low, meaning it's confirmed the market structure break. And then the next expansion leg, you wait for a deep retracement, 38.2, 21.4 there. Where do you frame your risk? This order block, just here. And so this would have given you a second entry if you missed the first one. Now, entering in New York after, if you missed the London entry, entering in New York is an art form. I'll admit to that. It's not easy to spot the second entry of the day. It's usually always there, but you need a bit more focus. And it's also a more risky entry because price could have come all the way back down here. So if the first entry of the day is in London, that's the one you want to take. But New York will usually give you a second chance. If the first entry of the day is in New York, great. Then if that's the first entry of the day, you can even trust that even more. And so you'd have had an 11 pip stop loss. And notice you would have had a higher risk to reward ratio even if you entered late. Can you see that? 11 pips, 46 pips. So you don't always have to take the first chance to get the most out of a trade. Don't be afraid to wait for confirmation. And sometimes that means you will miss the trade. That's fine. Trades are like bosses. Another one will come. One of the things we said you have to believe. Remember 2 weeks ago? There's a couple of things you have to believe about the Forex market to do well. One of them is price will constantly repeat itself. So that would have been the trade in EU today. And why would we have taken that trade? Well, we would have taken it based on the fact that yesterday, so this is Tuesday, that's Monday, This is Friday. Monday engulfed. Let me show you this on a clean chart. So this is how you see engulfings on a lower time frame. You don't always have to move to a 1 hour chart to see an engulfing. And this is how you should be measuring as a professional trader or aspiring professional trader. This is how you should be checking your price action, your institutional order flows. Is price making higher highs and lower lows, or lower highs and lower lows, or is it consolidating in a range without any clear direction? Right? So that's the low, that's the low, that's the high, that's the high. So look at this. This is Friday. Let me put these in green because these are daily levels. Right, so those are daily highs and lows. Now, that's why they're in green. Blue is just any level that I draw out on a 4 hour chart, on a 1 hour chart. So I'm going to put that in blue. This is how you measure price. Joshua, if you're on the line, this is how you form that story. You don't just jump around taking all the blocks willy-nilly, left, right, and center. It's how you form that story. So on Friday, we had a stop hunt on Friday. Price took out that low from Wednesday. It also took out this low from Tuesday last week. And then it made a 1 hour market structure break. This here was our first bullish signal. The fact that price closed above this level on Friday was our first bullish signal. However, we need to see price take out the high of a previous day. That happened on Tuesday. Kieran, if you're on the call, just let me know in the comment section that you're on the call, because I'm about to show you something related to what we spoke about an end of day trading principle. But I don't want to go into the details of it if you're not on the call. So let me know. You can just type something in the comment section to let me know that you are in this video, in this webinar. So this here, I'm giving you guys, this is a free, you know what? Let me just leave it. This is a free trading system I'm giving you right here. And it doesn't need a single indicator. You don't need a single indicator for this. And you can trade just this strategy I'm about to give you. You can trade it and you will be extremely profitable. Good. Thank you, Kieran. So this is signal 1 here. At the time, you don't know it's signal 1, but in one signal 2 forms, then you then come back and you call it signal 1 or part 1 of the signal. You want a level of liquidity taken out. and a market structure break. So part 2 of this is the market structure break. I'm going to type this out here for you in this section here. So 1, you want a liquidity hunt, in bracket, a stop hunt. Stop hunt / manipulation. Now, you will not know. Let me break that up. First of all, let's reduce the size. All right, secondly, let's break that up. Right. So step 1 is a liquidity hunt, in bracket, a stop hunt, a manipulation. Now, you don't know that that is a manipulation until after the market structure break. If price had just carried on coming down and then made a lower high and then another lower low, in essence, if market structure did not break, then 1 is never formed. It is when 2 happens that you can look back in hindsight and call this 1. That was the stop hunt, market structure break on a 1-hour chart. Now, this is the signal. You wait for a 1-hour market. So you wait for a daily low or high if it's the other way around. So in this case, it's bullish. Wait for daily low to be stop hunted and a market structure break on a 1-hour chart to the upside. So number 2, or step 2, market structure break. It has to be on at least a 1-hour chart for this to work. Do not trust it on a 15-minute chart. I see this happen all the time on a 15-minute chart. It's just a fake. You want this on a 1-hour chart. That's not going to fit. Okay, I know how to make it fit. We're just going to call the market structure break the MSB, as we usually do. I left it there for the newbies, but when you see MSB in our parlance or our terminology, that means market structure break. So now, number 3 is at some point in the next day, price breaks the high of the day in which the market structure break happened. Sometimes it could be 2 days, so that's fine, but you like it to be the very next day. The moment this happens, you have a bullish signal. You then have 2 opportunities to take that trade. If you're the risky kind of person, if you like risk, you can take it the very next day. Once it breaks it right here and comes back in and finds support, you got 2 chances to take that trade. The first is at the low of that day into an order block or any liquidity profile from the previous day. The second chance is somewhere in the region of the high of the previous day. As we've seen in the Forex Foundations, support and liquidity keep interchanging. Excuse me. An area of support and resistance. An area of previous resistance now becomes a new area of support. So you could have taken this trade on that same day, right? But I like to wait. This would have worked. I like to wait. So let's put this here, 3. Price breaks the previous day high or low if you're going the other way. Previous day's high or low. And this is the difficult part. This is the patience part. On day 4, so day 3, you want price to open up and find support if it's a buy in a liquidity profile from the previous day. This is valid. It has to at least come down here into that high. Here it touches into the pip. Usually it will sink into it by a few pips. So this is a perfect example, but usually to sink into by a few pips. And you want to line up. Let me see. There's a question. Can you take a buy trade twice in a day? If you see that a chart will, yes, you can, but your overall risk must still fall between your risk profile. There's no point saying I'm only risking 1% if you have 10 trades open at the same time. Then you're really risking 10%. So if your risk profile is met, is not violated, then yes, you can. I will more about that in the future. This is the money shot here. That's the open. It's the price open, right? Okay, there's another question. Let me see. If it happens on a Friday, is it valid for next week? Yes, it is valid for next week if it happens on a Friday. However, I would just give it a little bit more skepticism because Mondays are typically market maker manipulation days. But yeah, if it happens on a Friday, Monday next week is very, very valid for this to happen. No problem at all. And so, number 4. You want price to drop. Now, it is very important. You are not taking this trade above the open on the next day. It could go and leave you behind, fine. Don't be tempted because you see one opportunity where it just goes and leaves you behind. It's setting you up for heartbreak. You want to see the same price action principle. On an up day, you want price to find support beneath the open. But this is the key. Look at this. This is the key here. Forget the fact that you're in a new day. There's still a Fibonacci swing going on. And where are we? In the perfect buying range. Look at that. We're between 38.2 and 21.4. Perfect buying range. It lines up with this order block here. It also lines up with the previous or a previous day's high from here. This is perfect symmetry. Also, if you draw that from the very top to the very bottom, It's the 61.8 level. So you have perfect confluence. This is where you're taking your trade. You got some options. You could take it there and put your stop loss there. 25, almost 4 to 1. Or you could do what I did and drill down to a 15-minute chart and take an entry there. So for instance, you could come in here, first of all, at this one, 15-minute there, and or waited for the retracement in. Now, Kiran, this is the answer to your question. You see what we just did here? Let me put the 4 there. Four, take an entry beneath / above next day's open. Yep, I'm going to show you that, Kiran, in a second. Great question. Great question. I'm going to show you that. If it's bullish, you're taking it beneath. If it's bearish, you're taking it above. So, also, that has to form at a liquidity profile in the previous day. At a liquidity profile in the previous day. Okay. Of course, my personal approach, you know, I taught you guys how I take my intraday entries. Let me just add this here. PS. Look for an intraday stop hunt to confirm. So this is the intraday stop hunt here. This low that forms here is the stop hunt that for me would drive. So I want to see someone lose their stop before I enter my trade. I want to see somebody punished for being too eager before I go. Now, Kieran, so your question about pending on just now, good question. Keep this chart in mind. I'm about to open. Now, that exact same thing that we just saw, right? One second, I think I need to delete, and let me save that again as a template. Right, so second, where is this now? This one was here. Cool. I want to put these two charts side by side. right? So we're looking at pretty much the same thing. Cool? For all intents and purposes, we're looking at the same thing here. Cool. Right. Now, if you don't have time to trade 15-minute, 1-hour charts, if you are a swing trader, like Kieran is, if you are, in essence, you've got once a day you can look at your chart, right? And then you go to sleep. Or you go to sleep and you wake up in the morning and you're out the house very early. And maybe you can look at your chart twice a day. One at 8 in the morning, one at 4 p.m. at night, the last one at midnight. Well, when price opens here this day, you don't know where it's going to turn. So you don't have the luxury of making that guess. Now, let's look at here. So this is the day we're looking for today, right? Well, there's a couple of things you could do. The first thing you could do is look beneath the open price here and say, where are the order blocks? Well, there's one there, which is the one it respected. However, or slightly aware of the liquidity profiles, there is a manipulation block there. Price goes up and then comes down and then rips it through. So there's a manipulation block there. I would always go for the safer option. In essence, I would take this as my option. And if I miss the trade, if the price never got there, if it came here and then ran away, that's fine. I would much rather be on the outside of a trade wishing I was in than on the inside of a trade wishing I was out. I'd rather think, man, I wish I got in that trade, than think, oh Lord, what am I doing in this trade? So when I have a confluence like this, well, you've got two options. One is you can take the entire zone. So you can take your stop loss as this entire zone here. 13 pips, that's not bad. So take it from the start of the highest one all the way down to the low of the lowest one, or just choose the lowest one. It's your choice what you want to do. Now here, you could miss the trade. That's fine. You come back tomorrow. Or you just take the entire range. For the sake of argument, I'm going to assume we took the lower one. Right? 1 second. And you would just, 1 second now. All right, so, okay, control. Let's pop in a pair we can actually trade. So, right. Anyway, I'll figure that out later. So, you set your pending order 2 pips above this order block here. And if you are a day trader, I would not try and be too cute. Rather than put your stop loss there, just put it at the low of the previous day. In this case, that will be 30 pips. You're thinking, man, I could have made it 15. Yes, but you're not there to monitor your trade. If this price takes out this low, you know you were wrong. But it could come down into this second order block here. This would also be valid. Or the low. So this is what you would do as a day trader. Sorry, as a swing trader, as an end of day trader. Just draw your Fibonacci from high to low of the previous day. Wait at the 61.8 level. It lines up with another block. Perfect. My entry would be here. My exit would be at the low of the previous day. And today you would have gotten more than 221. Of course, the larger the time frame you are trading, the less your risk to reward ratio is likely to be, but also the more dependable or reliable your signals are likely to be. And on a normal day, I wouldn't get out there. I'd be looking to get to at least the 1618 level. If we got to the 1618 level, 28 pips to 91 pips, that is 3-1, roughly, right? Roughly 3-1. Great. Now, the reason why I'm getting out in this region is I know that this guy here, this is why we said you transpose liquidity profiles from a high time frame to a lower time frame. Because if a liquidity profile comes from a higher time frame, you must respect it on the lower time frame. Even if you expect price to keep going through it, this came from a 4-hour chart. It will at least be respected on a 1-hour chart. It may not stop price or reverse it, but you will see a reaction. And so you want to trade from liquidity profile to liquidity profile from a higher time frame, taking your entries on a lower time frame. So you can trade from a daily order block to a daily order block, taking your entries on a 1-hour chart. You get in at the lower daily order block, you get out at the higher daily order block. Or you can trade from a 4-hour order block to a 4-hour order block using the 15-minute chart as your entry. You can trade from a weekly or monthly order block to a weekly or monthly order block using the 4-hour or the D1 as your entry. That's the safest way to do it. But this is a way you can benefit from this kind of analysis even if you're an intraday trader. The moment you see this here, coming back here, 1, you don't know it's a 1 till 2 happens. You see the 4-hour market, 1-hour market structure break, right? And then the day after, you see price take out a high. Now, if this day took out a high here, let's assume, let me give you another example of when that could happen. Look at this here. This is perfect. So see this here? This day here, took out that day's low. So at the time, you may not have known, but this was 1. How do you know it's 1? When it completes a 1-hour market structure break. Where's the 1-hour market structure break? It is here. That's the 1-hour market structure break right there. So that's now 2. Right? But notice that same day, it didn't wait till the next day. That same day, it formed a bullish engulfing. It took out a previous day's high. In essence, you're ready to go. So 2 and 3 happened on the same day. In essence here. 2 and 3 happened on the same day. 4 is live tomorrow. Now, the issue with this day is, let's look at this here. Price opens up here. So we're looking for, actually no, that's the wrong day. This day here. Price opens up there. So we're looking for an entry beneath, right? Because our signal's bullish. Our engulfing was bullish. So our directional bias, right, is bullish. We're looking to go up, not down, right? Okay. Can you sit through this and not take a trade? This is the test. And as you can see, this day even further embellishes the fact that we're bullish, because it takes out another day. So let's call that 3.5. Let's call that 3.5. Can you ignore this? Can you not say, man, I knew I should have taken that trade? And there is a chance some days it will just go and leave you behind. That's fine. You have to be comfortable not jumping into every single trade. You need standards. Ladies, let's put it this way. Let the trade put a ring on it. Yes, I said it. Let the trade commit to your rules. If you don't date a guy who turns out to be a millionaire, great. If at the time he was acting like an idiot, that's fine. Don't risk your future on an idiot because you are worried he may turn out to be a good guy in the future. You need standards. Ladies, can I get an amen in the chat section? You need standards. You need to have rules. And you wait for the trade to commit to your rules. And you are happy leaving a trade alone that ends up being a good trade. What you don't want is to take a bad trade, because trades that violate your rules have a way of messing with your psychology. If you know you shouldn't have taken a trade and you lose it, it messes the fear, greed, pain, pleasure balance negatively. And so, also, this one comes down here. Look at this here, right? And then runs off. You're thinking, man, I should have. Nope. It is still. Yep, I'm getting some amens. Thank you, ladies. Where my amens at? Natalia, Gabriela says amen. Priscilla says amen. Esther just gives me a lol. Okay, she gives me an amen later on. Gerard, I said ladies. Even this isn't going to make you take the trade, because many of you will see this here and enter here. No. Your entry signal has to be beneath the open of the day. And it has to line up with a liquidity profile from the previous day. Where is the liquidity profile from the previous day? There is no liquidity profile here except for the market structure break. That does not count. This is the first liquidity profile from the previous day. It's the manipulation block. Look at that. Right? And I'm taking these two candles together because when you see two of them together, but if you really wanted to refine it down, it's that one. Can you see how easy this thing is? Can you guys see how easy this thing is if you are patient and know what you're looking for? That's the manipulation block there. If you want to take the low of the candle, not just the body, fine. If you want to be extra careful like I am, fine. 12, 13 pips. Now, would you take this entry here? Type yes or no in the comment section. This is 1900 hour server time. So that's 5 p.m. That's 5 p.m. our time. So this is actually the one. This is 6 p.m. But actually, one second. You're actually looking for a reaction. So you need an engulfing. This is the first one here. This is the first candle. So when it comes in, it definitely doesn't engulf this candle there. and then this one then comes back down. So this is the engulfing level. This here is the engulfing level. And so the first time it engulfs is at so that's 10 p.m. So that will be 8 p.m. London. Are you taking this trade here at 8 p.m. in London? No. Why? It's outside the window. 6 to 10, 12 to 3. 6 to 10, 12 to 3. I say it one more time. 6 to 10, 12 to 3. You just close your charts down outside those hours if you have itchy fingers. If you can't look at a chart and analyze without taking a trade, if you know you have trading addiction, between anything up to 6, well, 6 you should be sleeping if you're in London, and if you're in any other time zone, close your laptop down. At 10 a.m. in the morning London time, close it down. Open it again at 12 noon, and at 3 p.m. close it down again. Do not trust it. Will you have trades you miss out because they happen outside those time limits? Yes, you will. Let them go. You need a mechanical trading approach, something your brain can get used to. A, B, C, D, E, F, G. Tick, 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 tick. And if something happens that looks promising but doesn't meet those rules, you let it go so you don't confuse your brain. So we're not taking this entry. Why? Because it's not in the right time. It's not in the right time session. You're right. London time. Gerard, actually, it's a very good point. That is a very good point, because some people are watching from outside the Central European or Central West African time zone. A large number of our students are from Europe or Western Africa. And so we keep forgetting that everybody's not on our time zone. BST. That would be at this time of the year, because the time zones move around. That would be 1 a.m. Okay, so let's put that there. That would equate to 1 a.m., right? To 5 a.m. and 12 minus 7 a.m. to 10 a.m. EST. That would be the equivalent time in Eastern Central Time in the United Kingdom, United States. Does that make sense, everybody? Okay. So, in essence, no trade today. Kieran, no, you don't need to see a lot of sleepless nights, because, for instance, you could just wait. Most days, London will give you an entry. Or New York, sorry. Most days, the 7 a.m. to 10 a.m., your time will give you an entry. For every 10 days where there's a London entry, in 7 of them, there'll be a New York entry. Let me repeat. For every 10 days where there is a London trade, New York will give you an opportunity 7 times out of 10. But there are days where there will be no London trade, and the only trade will be in New York. That happens a lot of the time. So for instance, I personally, Kieran, I'm awake till about 3, 4 a.m. my time many nights. So I routinely sleep through London. It happens all the time. And some days I come up in the Telegram and I'm whining. Oh, I missed the trade. Did you guys get it? Because and they don't try to wake me up. Nobody asks for my account details to help me take the trade while I'm sleeping. They just take the signal and they're excited. But it is what it is. I'm only joking about taking the account details. I wouldn't give them to you anyway. But New York will half the time give you the other entry, and also 70% give you the entry, and half the time there will be no entry in London anyway. Now, when do we get the entry the next day? We get it in New York. Look. This is the first time it touches the zone the next day. That's 8 a.m. in the morning. But then you come back. That's 11 a.m. But it's still there at 12. And then we see the engulfing level there. And notice it's pretty much the exact same engulfing level as the day before. This candle engulfs this one there. It's pretty much the same level. In essence, if you'd entered the night before, you would have suffered this unnecessary drawdown only for the trade to be valid at the exact same point. It's not worth it psychologically. Get a good night's sleep if you're in London. If you're in any other part of the world, do your work without worrying about why your trade is going against you. That is the entry there. Stop loss, 21 pips. Or you could just trust that that's the low of the day. 18 pips. But let's take the maximum 21 pips. Your first target is here, back to the high. That's 3-1. And this is how you measure it. Once this trade, once the next day, so let me put this here. This will be a 4. Yep, Kieran, I love this. Let me just put this out here. Do not trade a system without concrete rules. Do not. I don't want to shout down I feel like swallowing my microphone because this does my head in, and then people come crying about well, how are you gonna measure something without concrete rules? Don't do it. Don't get excited. Oh, it's moving. No. You can do that on your demo account. See, I have demo accounts where I take everything. I just want to see if it pans out. I take everything. And majority of the time, they're not profitable. If I'm trading real money, I'm selective. Like I told you, I missed out on the trade today because I went into the week looking for a short. I saw the long playing out and I let it go. I let 3-1, 4-1 go because my brain this week is looking in one direction. And the week can end without me getting that trade and I'll be fine. When you blow tens of thousands of dollars doing the wrong thing, trust me, the right thing is not so difficult to do. With some grace. Right, so you get in here, you're holding for here. I would have come out of the trade here. The moment I saw this here, this would have been me done. I would have been out there. Why? Because I'm a high probability, low risk trader. There is an order block here. That's also a daily high. Right? That's a daily high. I'd have been out somewhere in that range. Actually, yeah, because when that candle closed there, that would have been me done. Still, it's not bad. 18. Is that up to 4-1? No, it's not. But still, this is why I don't have a problem getting out here, right? Because once this happens, if this is going to carry on, once this happens here, I expect it to give me another entry. Why? There to there, drawing it the wrong way, should go from high to low. From here to here. Bingo. You see this? You can't make this stuff up, can you? Where is that? The 38.2 level. In between 38.2 and 21.4. Why stay in? Also, it's the time of the day where I'm looking to come out anyway. Look at this. This happened at 1 second. No, that's not right. No, that's not right. No. Yeah. No. Yeah. So yeah, normally you would have tried, but anyway, I would still have come out here anyway. And then once this day starts, so the next day, this, let me put this here 1 second. This is 4. So 4 is your entry. Now 5 here is the proof that this trade continues is that the next day takes out another daily high. This is a sign that the trend is still bullish. You're taking out daily highs. So you put that Fibonacci in. Sometimes this doesn't happen the next day. This could have gone even higher this day. That's fine. Just let it go till it comes back. It comes back here. What time of the day is that? 12 noon. So at the end of London, yeah, you could still take this entry, but it doesn't engulf. So don't take it. Why? It doesn't engulf. The engulfing happens. Oh, I should have taken it. Relax. It's going to come back and give you another entry. When? At exactly 3 p.m. in New York. So you take that one. Right? You take this one here. Using that order block there. It rallies and comes back down. It messes around the next day. If you didn't take this here because it was exactly at 3 p.m., you didn't want to risk it because it was, see, 2:59 is valid, just for the record, right? 2:59 is still valid. 1 minute past 3 is not. But even if you didn't take that, the next day, price opens, drops beneath the open, where into the previous day's order block. So anything from 6 a.m., that will be 8 a.m. server time, is valid. So anything from here is valid. It dips in here, comes out there. That's your entry. This doji is your entry. You go to the bottom here. That's 18 pips. And again, you see here. So I would call this another 4. And another 5. Right? But this is why you come out at the daily high and wait for the retracement. Because the next day was an intermediate stop hunt. Look at that. If you drew that there based on this day, did you get a reaction at 38.2? No. You didn't get an engulfing? No. Or doji? No. Did you get a reaction at 21.4? No. Where was your reaction? At beneath the low. So there's a stop hunt here. We go straight back to number 1. Now, this one here has told us that price still intends to keep going bullish because it took out another daily high. But the moment it does that stop hunt, it has to win your trust. Ladies, think of it this way. Your boyfriend cheated on you. Your boyfriend said he was going to be faithful, so you're still going up, and then he comes back. Thank God you didn't take the trade because you were waiting for a reaction, but he cheated on you down here, right? If he cheats on you down here, you got to rebuild trust again. He's got to buy a whole lot of teddy bears and a whole lot of candy and a whole lot of shoes and Gucci and Louis Vuittons. He has to earn your trust again. So the process starts again. When the market structure break happens in the 1 hour chart, then you believe that this was a 1, right? You wait for the 3 here. It dips back down above the open. So this is why this is a valid trade here. It still happens above the open here, although I would have waited till day 4. Find support there, and then rallies, and then takes out this high again. So then you know the next day is valid for long. It comes down, dips beneath the open, finds support, again out of Fibonacci. Priscilla doesn't like. Okay, cool. Nobody's going to cheat on anybody. I just trying to make the point. You get the point, right? So, yeah, I know that can be touchy. So perhaps I shouldn't have cracked that joke. I apologize. It's 11 p.m. my time. I'm tired, and so then this there tells you the next day is valid until you see a reaction the other way. Now, if this breaks market structure, let's assume tomorrow it breaks market structure. Okay, this is a perfect example. Like it did on the GU chart. This is a perfect example here. Right? So it was doing all that coming up. Yep, no cheating. I agree, Esther. No cheating. Yes. And so this was doing all that stuff coming up, right? You could throw all the levels. It took out that high there, and then that high there, and then this one there. It was going. It came here to this day, took out that high. 1 hour market structure break, right? And then took out this low. So we believe the next day was going to be bearish, because this is now a bearish signal. So this is the 1. This is the 2. The next day, it opens here. It finds support above the high. It drops. But it drops back down into this. So now we start the process again. Now we have seen our 1. So this is now our 1 here. Again. This is our 1. One sec. What did I just do? Oh, sorry. This is our 1. The market structure break was our 2. Not turquoise. Market structure break was our 2. What are we waiting for now? Potentially our 3 tomorrow would be, if we threw on a Fibonacci on that, we waited around the 638.2, so somewhere in this region here. That's also this low here. So somewhere around, I'm just hazarding, I'm not saying it's going to be correct. It's just an informed guess. It's somewhere around this level tomorrow, using this manipulation block here. We could see this happen. And then this to take it back to that level that we're suspecting, either here or here, any of those two levels that we're suspecting. And then again, a drop to get in sync with the daily. So I hope you learned something from that. So looking into tomorrow, what do we expect? Well, on EU, we've run into this level here. And so let's see if that high goes. So I would say we're still bullish, although I am expecting a reversal. And I would not be surprised if that's the reversal we get. That goes into there and then comes down. That would be textbook to that level there. That would be textbook. So I will most probably not be trading tomorrow because it's too close there for me. If it came back down, let's see. If it came back down to that level-ish, 40 pips, that's not, nah. It would have to come back here for me to take this trade tomorrow. Drop down into that region there on E for me to take that trade more. Drop back down to that region here. So if it came back somewhere down here, then I could potentially see myself taking this. Anyway, there we have it. So any questions before I shut down the session? I gave you guys some homework, the beginners, at 11 a.m. this morning. Only one person has handed it in, but I did give you 48 hours to get it in. So if you send it in, I will get it back to you by Thursday morning at the latest. So Gerard, I saw your assignment. Well done, star student. Any questions? I know there's a bit of a delay between me speaking and you hearing me. So I'm going to give it a couple. All right, no further questions. Gerard, yes, a vision of support resistance. Sorry, that's what I meant. Yes. Okay. Excellent. Yeah, Priscilla, you go watch that webinar. It's in the Telegram. All right. So this is the part of the script where you guys bounce. Have a great week trading tomorrow in the market. Take care and bye-bye. See you guys at 11 a.m. tomorrow. Yes, Priscilla, the song.